When you operate a company in Denmark, your annual report is far more than a statutory obligation. It is a strategic tool that shapes how investors, banks, partners, and even potential acquirers perceive your business. In this video, we will unpack the essentials of Danish annual reports from an entrepreneur's perspective, focusing on what matters, why it matters, and how you can turn a compliance exercise into a genuine competitive advantage. Let's start with the basics. In Denmark, most limited liability companies, APS and AS in particular, are required to submit an annual report to the Danish Business Authority, the Erhvervsstyrelsen. The exact requirements depend on your reporting class, from the smallest entities in Class B through larger, more complex entities in Classes C and D. But the underlying logic is the same: transparency, accountability, and a fair presentation of your company's financial position and performance. As an entrepreneur, understanding this logic helps you make smarter decisions about how you present your business. At its core, the annual report typically includes a management statement, a management commentary, financial statements, notes, and, for larger entities, an independent auditor's report. Each component serves a distinct purpose. The management statement is a formal confirmation by management that the report is prepared in accordance with applicable rules and gives a true and fair view. This may sound procedural, but it is a direct signal of responsibility and governance. The management commentary is where you, as founder or CEO, can truly shape the narrative. Here you explain the company's development, performance, and financial position, as well as significant risks and uncertainties. For a Danish startup or scale-up, this is the section read most closely by investors and banks. It is your opportunity to put numbers into context, clarify your strategy, and demonstrate control over both short-term execution and long-term direction. Rather than treating the commentary as a generic overview, approach it as a concise investor letter. Explain your business model in plain language, who your customers are, what problem you solve, and how you create value in the Danish and, if relevant, international market. Highlight key developments over the year: new products, important partnerships, entry into new markets, or operational efficiencies. Crucially, tie those developments to the financial results. If revenue grew rapidly, explain the drivers. If margins were under pressure, be transparent about the causes and your plan to address them. Danish stakeholders value realism and pragmatism over hype, so an honest, data-backed narrative typically builds more trust than optimistic but vague assertions. Turning to the financial statements, you will usually see the income statement, balance sheet, cash flow statement, and a summary of accounting policies and keynotes. As an entrepreneur, your first objective is to understand what story these numbers are telling about your company. The income statement shows your top line, your cost structure, and your profitability. Look beyond the bottom line. Examine the mix of revenue, your gross margin trends, and your operating expenses. In the Danish context, investors are particularly sensitive to the balance between growth and discipline. If you are investing heavily in product development or market expansion, make sure your commentary explains how these costs are expected to translate into future revenue and whether your cost base is scalable. The balance sheet provides a snapshot of your company's financial health at year end, your assets, liabilities, and equity. For entrepreneurs, two themes are critical here: solvency and working capital. Solvency, your equity relative to total assets, signals resilience. In Denmark, if equity becomes too low relative to the company's capital, you may face legal obligations to act, so monitoring this is not only good practice, but a compliance necessity. Working capital, your receivables, payables, and inventory, shows how efficiently you convert sales into cash. Long receivables or high inventories can strain liquidity even if revenue looks healthy. And this is something both banks and investors in Denmark will notice quickly. The cash flow statement then bridges profit and cash. Many entrepreneurs underestimate how important this is. You can show a profit while running low on cash if you are tying up funds in receivables or inventory, or if you are investing heavily. A clear view of operating cash flow versus investing and financing cash flows helps stakeholders assess the sustainability of your business model. For example, recurring positive operating cash flow suggests your core business can fund its own growth, whereas consistent reliance on external financing may be acceptable in an early-stage Danish startup. But it requires a compelling growth narrative. Notes and accounting policies may seem technical, but they matter in Denmark's transparent reporting culture. The notes explain how revenue is recognized, how assets are valued, and how key estimates are made. As an entrepreneur, work with your accountant or auditor to ensure that your policies are both compliant with Danish GURP or IFRS, as applicable, and aligned with how you actually run the business. For instance, if you capitalize development costs for a tech product, be prepared to explain the criteria you use and how this impacts your profit. Sophisticated investors will read these notes to understand the quality and sustainability of your earnings, not just their size. For many Danish companies above a certain size, an independent audit or extended review is either mandatory or strongly recommended. While it might feel like an extra cost, an auditor's opinion can significantly increase the credibility of your numbers, particularly if you are seeking bank financing or planning to raise capital. From an entrepreneurial standpoint, treat the audit as a sparring partner exercise rather than a box-ticking exercise. Use the process to strengthen your internal controls, refine your financial processes, and identify risks early. An auditor who challenges your assumptions is often helping you avoid bigger issues down the line. Timing and process are also important. In Denmark, annual reports typically must be submitted within a set deadline after the end of the financial year, often within 5 months for smaller entities. Missing deadlines can result in fines and, in extreme cases, compulsory dissolution proceedings from the Danish Business Authority. To avoid last-minute pressure, organise your reporting calendar well in advance. Close your accounts promptly after year-end. Schedule time for management to craft the commentary and align with your accountant or auditor on key milestones. From a strategic perspective, consider whom you are really writing for. Even if your immediate audience is the regulator, your annual report is often read by potential investors, banks, suppliers, and future employees. Denmark has a strong ecosystem for startups and SMEs, and professional, transparent reporting signals that you are ready to engage at a higher level. Use your annual report to reinforce your brand. Consistent messaging about your mission, values, and long-term strategy, aligned with your website and pitch materials, makes you look coherent and well-managed. Increasingly, stakeholders in Denmark also expect insights beyond pure financials, especially around sustainability and governance. Even if you are not yet legally required to provide extensive ESG reporting, you can use the management commentary to address areas such as environmental footprint, social impact, and governance practices at a high level. You do not need to overcomplicate this. Focus on what is material to your business and sector. For example, a manufacturing company might discuss energy consumption and supplier standards, while a digital startup could talk about data protection and responsible use of technology. This positions you ahead of the curve as EU sustainability reporting requirements continue to expand. To make this practical, as an entrepreneur, you can follow a simple checklist when preparing your Danish annual report. First, clarify your objectives. Is this year about demonstrating stability, showcasing growth, or preparing for funding? Second, ensure your financial data is accurate and timely, with clear documentation. Third, craft a concise management commentary that connects your strategy, operations, and financial results into a coherent story. Fourth, review your notes and policies so they are consistent, understandable, and aligned with your reality. Finally, seek feedback from key stakeholders, your board, lead investors, or advisors before you file. Their questions will often highlight areas that require better explanation or additional context. In closing, Denmark's annual report requirements can appear complex, but when approached thoughtfully, they become a powerful strategic asset. By combining regulatory compliance with clear narrative, robust numbers, and forward-looking insights, you build trust in your company and open doors to financing, partnerships, and growth opportunities across the Danish and broader Nordic ecosystem. Treat your annual report not as an administrative burden, but as your professionally verified story of the year. And as a founder, that is a story you cannot afford to leave untold.